Good morning and welcome to the second day of the 2012 ASF Annual Conference. Yesterday we had some very insightful presentations on the regulatory environment unfolding for securitisation in Australia, and today we are covering topics more related to the markets and the outlook for securitisation and covered bonds. Before we start, just a reminder to please turn your mobile phones and tablets to silent mode to avoid interruptions during our sessions this morning. And if you'd like to keep up with the upcoming sessions, you can do that through the conference app, which you can access by typing in asf2012.mobi into your web browser. I'd also like to remind you that questions for this morning's sessions can be sent through, and the number to do that will be on the screen from time to time, but if you send those via your mobile, the number is 0439 883 481. And don't forget to put the keyword, which is ASF 2012, and leave a space before your question, and then there is the 130 character limit on the question. To introduce our first speaker, we're extremely fortunate to have a very distinguished keynote speaker to address us today. The speaker needs little introduction. Dr. Ken Henry is one of the most prominent commentators and most experienced people in financial markets, given his career both in the public sector and more recently in the private sector. Dr. Henry is going to speak to us on a topic that will continue in the sessions that follow this morning and throughout the day. And the general theme is the role of fixed income in investment portfolios and the issues around Australia's increasing longevity of life and the ageing of the population. Dr. Henry is very well qualified to speak to us on this topic. He delivered a presentation at an earlier conference in March this year to an ASF investment interchange, which got quite a bit of press, and I'm sure Dr. Henry's comments today will be a follow-up and very insightful as well. A few highlights of Dr. Henry's career. He has been recently, in 2011, appointed as a special advisor to the Prime Minister and is currently leading a team and will shortly deliver a white paper on Australia in the Asian century, which I think will be a groundbreaking piece of work and much anticipated. He holds a number of positions since he left the Federal Treasury. He's currently chair of the Institute of Public Policy at the Australian National University. He's a chair of the Advisory Council of the Smart Infrastructure Facility at the University of Wollongong. And he's a member of the board of National Australia Bank, who are a key sponsor of our conference and a valued member of the ASF. So I'd now like to invite Dr. Henry to come to the podium and to provide some comments on fixed income and its role in Australia's investment markets.
Well, thank you very much, and it's good to be here. So I'm going to talk to you about a topic that I have addressed on one occasion in the past, that's at least publicly, although I have to say to you I've been thinking about these issues for quite a number of years, and I've entitled this presentation, Why is Portfolio Allocation to Domestic Fixed Income Low in Australia, and Should it be increased? The question, I guess, is in the minds of many of you is how it should be increased. I don't go into that in much detail, although I make some comments on it. Before I commence, I should make it clear that whilst, as has been mentioned, one of the hats I wear these days is a special advisor to the Prime Minister in the development of a white paper on Australia in the Asian century, I'm obviously not appearing here before you this morning in that capacity. I am a non-executive director of the National Australia Bank, and I'm very happy and proud to be wearing that hat here today, but obviously the views that I'll express this morning are my personal views. Well, as has been mentioned several months ago, I had the opportunity to address another conference on a similar topic. The first thing I want to do this morning is summarise what I said then. I then want to expand a little on a couple of the points, which, given the subsequent commentary on these matters, seems to me to warrant some greater emphasis. I'll then provide some comments on some of the issues I think we're going to have to deal with in overcoming what I really do consider to be a serious bias in investment behaviour in Australia. So firstly, the core arguments. Australian superannuation funds, as you know, allocate not much more than 1/10 of their assets to fixed income, and that compares with an OECD average of about 1/2. Not only is Australia well below the OECD average, we're at its bottom. No OECD country allocates a smaller proportion to fixed income assets. Many explanations have been provided for this apparent bias. Some explanations point to deficiencies in the supply of fixed income product. Others point to peculiarities in the demand for fixed income assets. The particular explanation that I've wanted to explore is what I perceive to be a deep demand bias towards equities. Equities are viewed as growth assets, as assets that provide fund members with upside exposure beyond what is offered by a fixed income product. And it's argued that the benefits of fund members being exposed to such growth assets is increasing as people live longer and as they become more aware of so-called longevity risk. Frankly, I find these arguments absurd. I'll deal with the issues associated with increasing life years in a moment, but first let's go back to basics. Let's remind ourselves that the equity premium is not a gift to investors. It's what they require in order to compensate them for the additional risk to which they are exposing themselves in holding an instrument on which the economic income is uncertain and variable due to fluctuations in dividends and capital value. The historical evidence suggests that it is generally the case that over a sufficiently long period of time, a portfolio of shares will outperform a portfolio of fixed income assets. But it will not always do so. In some years, the share portfolio will lose more than half its value. This is what history tells us. This observation has encouraged an interest in sequence risk. But it's disappointing that so much of the recent discussion about sequence risk concentrates on the post-retirement period. In my remarks on sequence risk some months ago, I pointed to the equally serious sequence risk that is present in the accumulation phase. I'm not sure that the arguments cut through, so I'm going to have another go at it, and I hope this won't bore too many of you. But here's a little example for you. Suppose it is known with absolute certainty that a share portfolio yields a 10% rate of return in 19 years out of 20. But in the other year, it earns a negative rate of return of 50%. It has a standard stock market crash in 1 year out of 20. But let's suppose that nobody knows in which of the 20 years that negative rate of return, that stock market crash, will occur. The capital sum invested in this share portfolio today would be 3.06 times larger in 20 years' time, and that implies an average annual rate of return of 5.75%. Now, you've all studied arithmetic, so you know that due to the commutative law of multiplication, that same average rate of return is obtained irrespective of the year in which the negative return occurs. That is, it doesn't really matter in which year the stock market crash occurs. Suppose there's an alternative investment that generates precisely 5.6% in every year, but this time with absolute certainty, in every year 5.6%. The difference in average annual yields between these two investment strategies is not large. It's 15 basis points a year, but of course this is a 20-year investment. On a $500,000 upfront investment, that's a difference of more than $40,000 in 20 years' time. Surely a superannuation fund member offered these alternative investment strategies would prefer the share portfolio. Well, no. There are two matters to be considered here. The first has to do with loss aversion. The second has to do with sequence risk. Let's deal with loss aversion first. The share portfolio exposes the investor to a loss in 1 out of the 20 years. On an initial investment of $500,000, you know what the minimum loss is. It's obviously $250,000. The maximum loss is $1.5 million. The smaller loss is what's suffered if the stock market crash occurs in year 1, while the $1.5 million loss is what happens if the stock market crash occurs in year 20. In the alternative investment, no loss is suffered in any year. Because of loss aversion, it's quite possible that many investors would prefer that alternative investment, even though it certainly generates a nest egg in 20 years' time that's more than $40,000 smaller. Now, of course, the loss aversion involved here is not rational, but that doesn't mean it can nor should be ignored. The second matter, the matter of sequence risk, is even more important. In the simple case in which a lump sum is invested in year 1 and the investment terminated in year 20, there is no sequence risk. Because of the commutative law of multiplication, the average annual yield is independent of the year in which the stock market crash occurs. But that style of investment is not representative of the accumulation phase of superannuation. Instead of investing a lump sum up front, superannuation fund members invest an amount every year over a number of years. This fact changes the arithmetic in a profound way. It means that the average annual yield is very much dependent upon the precise year in which the stock market crash occurs. To keep things simple, suppose a superannuation fund member contributes the same amount every year for 20 years. Suppose the stock market crash occurs in year 1. Then the average annual yield of the member's superannuation portfolio, calculated over the full 20 years, is 9.51%. The reason it's so high, just a bit below the 10%, is that only 1/20th of the capital invested is affected by the stock market crash. 19/20ths of the capital is contributed after the stock market crash has passed by. Suppose instead that the stock market crash occurs in the 20th year. Then, of course, all 20 annual contributions are affected. The average annual yield in this case is not 9.51%, it's 3.31%. That's the average 20-year yield. In a 20-year superannuation accumulation, the difference between an average annual rate of return of 9.51% and 3.31% is not immaterial. Suppose the annual contribution is $25,000, implying a total contribution over 20 years of $500,000. The first case, in which the stock market crash occurs in year 1, generates a final lump sum $750,000 larger than if the crash occurs in year 20. 1.5 times. The difference is 1.5 times the capital contributed. So let's ignore loss aversion. Would a rational superannuation fund member prefer the share portfolio or the alternative investment generating a certain 5.6% a year? Well, because we don't know in which year the stock market crash will occur, the 9.51% average annual yield and the 3.31% average yield are equally likely. And of course, there are another 18 average annual yields that also have precisely the same probability, that is a 1 in 20 chance of being right. If you do the arithmetic and you calculate the full probability distribution, you'll find that of the 20 equally probable rates of return, 10 are larger than 5.6% and 10 are smaller than 5.6%. There's a 50% chance of doing better than the alternative investment and a 50% chance of doing worse. Would a rational investor choose the share portfolio over the alternative investment? Well, who knows? She might as well toss a coin. Of course, the real world is much more complex and uncertain than this simple example. In general, however, it is the case that a superannuation fund member's average annual rate of return depends upon the precise sequence of returns. In the accumulation phase of superannuation, then, sequence risk is real. Now I want to turn to some other matters. I want to turn to the implications of people living longer lives and becoming increasingly aware of longevity risk. Longevity risk, I think, is best defined as the risk of exceeding life expectancy at the date of retirement. For an example, an Australian female who retires at, say, age 65 today might have a life expectancy of 22 years. Longevity risk refers to the risk of living beyond age 87. How should one respond to both increasing life expectancy and to the risk of living beyond life expectancy? Well, the publicly provided age pension system provides a safety net. And for many Australians, that is how both things will be managed. But all of us in this room would be interested in understanding how we might want to adjust asset accumulation to finance private retirement. That is, above and beyond the publicly provided safety net. Clearly, we would want a higher stock of savings at the date of retirement. Three options present themselves. There are only three. First, increase the rate of saving during the pre-retirement period, that is, in the asset accumulation period. That's one option. Second option, retire later, that is, retire at an older age. Third option, there are only three, find some way of securing a higher rate of return on your savings. It's scarcely surprising that people would be attracted to the third of these options. But I doubt that many of them understand the implications of choosing that option. The fact is, nobody can guarantee a higher actual rate of return on saving. Instead, what people get offered is a higher expected rate of return. With that higher expected rate of return comes higher risk, including the risk of losing a large proportion of the stock of savings. That is, the risk of becoming very much worse off. As life expectancy increases, people should either increase their rate of saving, or they should work longer, or they should do both. The idea that they should move ever further out along the risk-return frontier in the northeasterly direction strikes me as dangerously misguided. It might seem logical to seek a higher expected rate of return to match higher life expectancy, but because of the sequence risk involved, it's not. The idea that longevity risk is best managed by increasing one's exposure to equities and thereby taking on a greater degree of sequence risk is even more worrying. It's certainly better than encouraging an aged pensioner to put a pension cheque through a poker machine, since the expected gain in the former case is positive, while of course in the latter case it's negative, but the actual outcome can be just as disappointing. I know it's an old-fashioned notion, but I do think risks, and that includes sequence risk, are managed best by taking out insurance, not by substituting one set of market risks for another. As I've noted on an earlier occasion, in our report to the Government on Australia's future tax system, my review panel colleagues and I recommended that there should be no restrictions on people wanting to purchase longevity insurance, including in the form of a deferred income annuity from a prudentially regulated entity. We also recommended that the government issue long-term securities to help product providers manage the investment risk associated with longevity insurance, that it also remove certain restrictive rules in the SIS regulations relating to income streams that restrict product innovation, and that's a recommendation that was repeated by Jeremy Cooper in his review, and that it consider offering an immediate annuity and deferred annuity product that would allow a person to purchase a lifetime income up to a cap that limits the taxpayer's exposure to longevity risk. Okay, so what's missing and why? Obviously, I think there's a strong argument on retirement income grounds for superannuation funds having a considerably greater exposure to fixed income products, but that's easier said than done. Suppose we all thought that way, what would we need to do? Well, later today you're going to have an opportunity to consider matters affecting both the demand and supply side of fixed income markets in Australia. I'm not going to cover those issues in any detail here and now, but I want to make just a few remarks. In addition to retirement income considerations, there are significant macroeconomic issues at stake here. The development of superannuation in Australia has had a big impact on the flow of funds in the Australian financial system. Considering the national balance sheet, it's produced a larger exposure to foreign equities accumulated by our superannuation funds, and a correspondingly larger reliance on relatively short-term foreign debt intermediated principally by the Australian banking system. That has exposed the Australian financial system to a greater degree of refinancing risk. Now, prior to the global financial crisis, we thought that refinancing risk should be managed by focusing on the quality of our domestic policy settings. We now know, because of the global financial crisis, that our ability to access global debt capital has a lot more to do with the quality of policy settings and regulatory performance in a lot of other places, especially in the United States and Europe, That is to say, this matter is not entirely within our control. Thus, it's strongly in our interest to find ways of reducing over time the bank's reliance on offshore debt finance. One thing that would help is the development of a deep and liquid domestic retail corporate bond market. Developing any market requires willing buyers and, of course, willing sellers. To date, the growth in Australian corporate bond issuance has been biased heavily to international markets. We need to understand why that is the case. And, as I've noted, institutional investors have a strong bias for equities over fixed income assets. This morning I've emphasised one source of bias, but many others have been identified. All of these need to be scrutinised closely. I don't want to go through them now, but I should say something about one in particular. I've often heard it said that superannuation funds allocate such a large proportion to equities because of the Australian company tax imputation system. Now, I think that's likely to be an important factor, but the question is how important. Australia's superannuation funds allocate about as much to foreign equities as they do to domestic equities. And obviously they don't get any franking credits on foreign equities. And in both cases, that is in respect to both foreign equities and domestic equities, they allocate about 3 times what they allocate to fixed income assets. It seems to me that if superannuation funds are allocating 3 times as much to foreign equities as they are to domestic fixed income assets, it's not the imputation system that explains it. So it might be important, but I suspect it's of secondary importance in explaining the bias in favour of equities over fixed income investments. Here are some other things to ponder. First, to what extent are fixed income asset allocations affected by the focus on fair value accounting and mark-to-market requirements? Fund member objectives can be secured by a hold-to-maturity strategy, but measures of fund performance might make such strategies non-viable. And maybe this is especially the case in a world of members' choice. That's the first issue. Second, not all fixed income assets are the same. The fixed income class covers a diverse set of assets, from government bonds to hybrid instruments and asset-backed securities. Do the same considerations apply to all such instruments? Third, given the ability of securitised products to precisely match the tenor of the underlying asset with the tenor of the liability, are these products, that is securitised products, best suited to deliver the long-term annuity-style assets that would support superannuation pensions? Fourth, supposing securitised assets were to play a larger role in superannuation fund asset allocations, would the banks continue to play the role they have to date in funding the origination of assets through securitisation technology in private warehouse transactions? To what extent might the credit oversight provided by banks be important to the future development of the market? And fifth, what role should government play in the development of deeper, more liquid fixed income markets in Australia? Well, let me conclude. I don't have the answers to any of those questions. But these are only some of the questions that are going to have to be answered before we might understand why it is that the portfolio allocation to fixed interest and fixed income is so low in Australia, and whether and by what means it should be increased. Thank you.
Would you like to take a seat and take some questions?
Sure.
Dr. Henry has agreed to take some questions, so if you'd like to text those through, the number again is 0439 883 481, keyword ASF 2012, a space, then your question. Dr. Henry, maybe I'll kick off by sort of asking a question. You spoke about the allocation to fixed income. Do you sort of have a view as to whether the allocation should be more to domestic fixed income, or doesn't it matter whether it's global fixed income versus domestic?
Well, for asset allocation reasons or fund management reasons, the question there is currency risk and what exposure you want to currency risk. That's a principal, not the only consideration, but the principal consideration. But from I referred in my prepared remarks also to the macroeconomic issues, and the macroeconomic issues I think strongly favour a somewhat greater allocation to domestic fixed income as opposed to international fixed income. Australian Australian economy already has quite an exposure to both foreign assets and foreign liabilities, and that in and of itself is no bad thing, provided markets don't seize up. But one thing the global financial crisis has taught us is that markets can indeed seize up, and I think it's something worth bearing in mind. I've never been in favour of proposals that would restrict any investor, and that includes superannuation funds, from investing offshore. Never been in favour of them. The purpose of superannuation has to be to provide better retirement incomes for retirees. That's the only justification for it enjoying the tax concessions that it does. And if it is the case that the fund members' returns will be benefited by a share of the portfolio being invested in foreign assets, then that's precisely what should happen. Mm-hmm. But what worries me is that some of the people who are taking those decisions do not really understand, or if they understand, do not reflect to fund members the full risks that are being taken on.
Mm-hmm. The other sort of aspect of this is that we have an unusual pension system in as much that we have a very large component that's accounted for by the self-managed super fund sector, something around 400 billion and growing.
Yeah.
Do you have any comments on the freedom that the self-managed super funds have with respect to their investments and the knowledge of fixed income as an asset class amongst those self-managed super funds?
Yeah, I think this is a particular issue. I really do. But I don't know if it's the biggest issue, because I think there is a very big issue in the institutional area. I think there is a bias in the heads of those who are advising funds on how assets should be allocated. I really do think that. I would love to be convinced otherwise, but I really do think that. But there's an issue also in the self-managed superannuation fund area. It is the largest single pool of superannuation assets, and it's also the fastest growing pool of superannuation assets. And of course, it's not prudentially regulated. It's regulated effectively by the Australian Taxation Office. The question that Taxation Office concerns itself with is whether there's been tax avoidance or something worse, but it doesn't concern itself with any of the purposes of superannuation. Mm-hmm. And that's an issue. Successive governments and advisors to government have been comfortable observing the rapid growth in self-managed superannuation fund assets, but I think there is a legitimate public policy interest in being, at least being interested in the assets that self-managed superannuation funds are investing in. Mm-hmm. Whether there should be more heavily mandated investment protocols, let's call it that, for self-managed superannuation funds, it's not something I've ever argued, and I'm not wanting to argue it here this morning, but it is something that should be thought about, I think. Mm-hmm.
We've had a question come in from the audience on this topic, and it sort of asks how likely is government to ultimately dictate asset allocations?
Yeah, pretty unlikely, I think. And that goes back to the comment I made earlier, which is that in Canberra there is the view is that superannuation exists for the benefit of fund members, and that when the superannuation guarantee was introduced in the early 1990s, one of the questions that had to be asked, and I remember being involved in this as an advisor myself at the time, one of the questions that had to be asked was, well, given that this is going to lead to quite extraordinary growth in funds under management, and given that it's underwritten by tax concessions, even though there's the compulsion is there, or maybe because both of compulsion and tax concessions, should there be a fund, and should the fund be run by the government? This is way back in the early 1990s. And the view that was taken then was that Australia would have a much more dynamic financial system if it was left to the private sector to manage this pool of savings. And that's still the view in Canberra, and I think it's the right view. So I'm not in favour of, I wasn't in favour then, and I'm not in favour now, of Australia having a monster publicly owned fund that manages all of the retirement savings of Australians. The future fund, if you're wondering about that, is in quite a different class, and there are different considerations relating to that. And I'm not in any way wanting to say that the future fund should be managed on any different basis, and I certainly don't believe that. And I will be hopefully one of the beneficiaries one day of the future fund. But so I think, given the decision that was taken in the early 1990s that this stuff should be managed by the private sector, and that private sector management would in and of itself contribute to the development of a more dynamic financial system in Australia, I think it's very unlikely that governments would then want to step in and tell the private sector how it should do its work.
Okay. Another question from the audience, sort of following along that theme. I guess someone's asked, given that we're clear about the problem, what are the two practical political catalysts that are required?
I don't know about two. Look, the only thing that really occurs to me, and it goes to transparency. There's been a lot of people who have tried, and with some success actually, to enhance the transparency of reporting of superannuation funds, managed investments generally, actually. A lot of people have tried, a lot of people have had some success. APRA over the years has had some success. Jeremy Cooper in his report referred to the need for enhanced transparency, better reporting. But you see, the reporting that occurs at the moment is not the reporting that is likely to shed a light on the issues that I was discussing this morning. Not likely to tell you much at all about sequence risk. I think it would be useful to, and I'm not sure how it should be done, and I haven't thought deeply about it, but I think it would be useful to have some reporting by superannuation funds of the average, let's say, 20-year experience of their members, and have that compared with, a benchmark, right? A fixed income benchmark. That would be useful. It'd be really interesting to know what proportion of superannuation fund members, when you take into account the sequence risk that they've been exposed to, really would have been better off having an investment in fixed income throughout the 20-year period. So I think that would be useful. And that could be quite compelling, I think. I'm not sure. What else? Well, one other option that occurs to me, I suppose, is that now that it's just something to think about. Now that government these days has decided that people should have a simpler superannuation option, effectively a default, and given that sequence risk obviously becomes an increasingly important problem as people age, it might be worth thinking about, and I don't have a concluded view on this, but it might be worth thinking about whether it makes sense to have different style default asset allocations as people age. Maybe government could play a role in that. But as I say, I'm just raising that as an issue to think about. It's not something that I have a strong view on.
Okay. Again, a question that's come in sort of going along the same thought. The question asks for a comparison of the retirement phase here in Australia in terms of how it's managed and how that compares to the retirement phase and the products that are available in other countries. Listen, I didn't concentrate on this issue in my remarks because I wanted to focus on the accumulation phase, because I think the debate on the accumulation phase has been underdone
or the discussion or the understanding of the accumulation phase has been underdone. But in the retirement income phase, or the drawdown phase, if you like, the issues are even more important, of course. And it is the case that in Australia, members, when they retire and when they take their benefit out of the superannuation fund, have much greater flexibility in Australia than I think anywhere else, but almost anywhere else anyway, about the form in which they take the benefits. This too is something that has been an issue in public discussion in Australia ever since superannuation became a public policy issue, and that's actually 1983. Actually 1983. People first started asking this question, whether, so this is well before the superannuation guarantee was introduced, whether the government should restrict people from taking lump sums, given the taxation concessions that were available for lump sums compared to superannuation pensions. Of course, these days things have changed quite considerably, particularly for those who take their benefits out of a superannuation fund after age 60, when the benefits are tax-free, no matter in which form they're taken. But the issue that's in the public debate now, and it was also in the public debate at least in the mid to late 1980s, I remember it very well, is that, well, the taxation issues are one thing, but the exposure of the publicly funded age pension system, particularly with an ageing population, that's another thing. And so the issue that's been in public debate in Australia recently is the risk of people, well, the phrase that's used is double dipping. I first encountered that phrase back in the I think it was 1988, in Canberra anyway, when people were talking about the risk of people double dipping. Of course, in those days, what people were talking about was the risk of people retiring with a relatively small superannuation lump sum and using it to buy a boat, a modest boat, something with an outboard motor, and then going on a round-the-world trip and then lining up for the age pension. So maybe they're going to blow $20,000, maybe, and then line up for the age pension. Well, the debate has really moved on. And the reason the debate's... because today people talk about the risk of people retiring with a large lump sum, paying off $500,000 in debt, housing, mortgage, various other debts, and then lining up for the age pension. Things really have changed. I don't know how many people are actually doing that sort of thing, and frankly, I don't know how serious an issue it is in public policy terms anyway. Better, of course, that people retire with if they're going to take a lump sum, that they retire with a lump sum that's big enough to pay off their debt and also to provide them with a private income in retirement, rather than just paying off their debt and then lining up for the age pension. But debt-free pensioners, debt-free age pensioners is not the worst sort of world for the Australian population. Mm-hmm. Heavily debt-burdened age pensioners is closer to the worst world for Australia's age population. So I don't know. I can see both sides of this one. Mind you, I do think that it would be of enormous assistance to the retirement income market, to the individuals themselves, if we did have much greater use of annuity-style products in the retirement phase. Somehow we do have to get there. I just, my feeling is that we will get there. And maybe there's a chicken and egg issue in it. I don't know. Maybe the real issue is that people don't understand the full risks that they're exposing themselves to. Maybe they really don't understand longevity risk or just don't care about it. Maybe they don't understand what their true life expectancy is at age 65, that, you know, as I said, if you're a female, you've got another 22 years expected life, and of course some will live a lot longer than that. And I think it's the case, somebody in the audience will know whether this is the case, but I think it's the case that if a couple at age 65, it is very likely that one of the couple will live to be more than 100, if two have survived to age 65. Anyway, so maybe people don't understand the longevity risk, and it would be very useful if we had instruments in Australia, and we are going to need them, that allowed people to take out insurance against longevity risk and to secure regular income streams rather than just paying off debt and then having the nasty surprise some years, maybe only 5 or 6 or 10 years into their retirement, that they end up on the age pension and have nothing else.
We might just take one more question, and this could be maybe a simple answer, Dr. Henry. I think you've covered it slightly. Should retirees be able to simply purchase an annuity from government, and then government can handle the longevity risk as a portfolio? Okay,
so in the tax review we recommended this as an option. Now, I know that not everybody, and certainly not everybody in this audience, would think it's a good option for the government to be competing with private providers of these products. But in fact, the reason that we came to that recommendation in the tax review is because we thought that somebody really had to take the lead here, and we thought that it was likely that a government product would have a lot of customers. Obviously because there's a very low counterparty risk involved for the purchaser, you would have thought. Well, at least in the case of the Australian government. It may not be the same if you're in Europe somewhere, but at least for the Australian government. So that's why we recommended it, really as a market leadership thing. Now, if that sort of market leadership is not required, fantastic. But the longer this goes on with such small rate of growth in these products, I think the more compelling the case becomes.
Okay. Look, we might conclude there. We would like to thank you very much for joining us this morning and providing that commentary. From the ASF's point of view, we believe the issues that you've touched on are important, and our industry certainly has a desire to continue leading the discussion around the development of the bond market and its role in providing greater allocation for investment, and particularly through superannuation. So please join me in thanking Dr. Ken Henry.